Good morning. Is that on? I think it is. Okay. Well, good morning. My name is Megan Crane. I'm an Associate Director of Assurance at Dean Dorton, and I run our higher ed team. Thank you all for joining us today. We have several in person, so high five to the people in the room. And then we have about 130 people joining us online this morning, so a big crowd there. For those of you that are new to this event, this is our 9th year hosting this training day for finance professionals, student financial aid professionals, and other business officers. And each year we try to address topics that are current, what's happening, what's going on, what needs to be on the forefront of your mind. We do have some exciting guest speakers today and hope you get some valuable insights to take back to your organization. For those that may not know much about Dean Dorton, we were founded in Lexington, Kentucky, and we have expanded from Kentucky to Louisville, Kentucky, and then now into Raleigh, North Carolina. We are a business and advisory firm with tremendous experience and, again, specialization in higher ed. We know higher ed is a complex industry, so we do like to spend time and invest to understand that industry. If you're ever in our area, we'd love to meet up with you. Or if you're attending from a campus, I'd love to come visit you there too. All right, before we get into the real meat of everything. Okay, can't get the clicker to work. Here's our agenda for the day. Of course, right now we are in the welcome, probably the highlight of the day, I'm sure. After me, we have Kaydee Ruppert from our, she actually lives in Wisconsin, but she's part of Dean Dorton and runs our nonprofit team. So she's going to talk a little bit about endowment management. We'll have a breakout sessions, FASB and GASB, another break, and then we'll have an information security update with Kevin Cornwell from our office. Just after lunch, we have our first keynote speaker, which is Pfeiffer University. They'll be going over discounting and very interesting story about kind of where they've come from in the last few years. So I think you'll enjoy that. Another break, and then we'll go over fraud. And then at the end of the day, we're wrapping up with Lisa Simpson from the AICPA. Lisa's going to talk a little bit about the talent pool and how you at universities can help us make sure that there's people to replace you all, business officers, and help public accounting going forward. We are using live polling today. Of course, you need to participate in polling in person or virtually to get full CPE credit. We're going to do a test for this. So what you want to do is get out your phone at this point, and you want to put in the 2. So the number would be 22333. And then the message should be Dean Dorton. Okay. And here's our first polling question. What is your favorite color? Very nice. Nobody's favorite color is yellow. Okay. Oh, we have one person physically raise their hand. That's not how the poll works. You've got to actually text it in. We do have about a 60-second time limit on these, so make sure you're paying attention and get those answered quickly. If you are in person, there are restrooms located out the door either direction, and lunch will be taking place next door. We can all follow each other getting there. If you are attending virtually, a couple of announcements for you. If you're having problems, it helps if I do the slides, I apologize. If you're having any issues, you can email Julia Ray, jray@deandorton.com. She can help you troubleshoot and get you in the right direction. If you have questions, you could use the chat feature, which is down at the bottom of the screen. It says chat. And someone will help monitor those, and then we'll make sure to repeat the question so that way you can hear it. And your materials have been sent to you and are available for download at the bottom, again, under that documents to download. We do have breakout sessions today, FASB and GASB. If you're on FASB, you'll actually stay physically in this room or this virtual room. And if you're GASB, there's another link for you to join a different room. So physical GASB, you'll leave this room. Virtual GASB, you'll have to click a different link to join. All right. CPE credit. Awesome. Be an active participant, please. Attend the entirety of sessions. If you are virtual, part of the way that it is tracked in Zoom is by your username. So if it's Hello Sunshine, we don't know that that's you. So please put in your first and last name and then your institution. So Julia Ray, Dean Dorton, Megan Crane, Dean Dorton, whatever, so we can identify you. Please include your organization because no offense to the Joe Smiths of the world, but there could be a lot of you. And so let's make sure that we can track that appropriately. We will send out CPE certificates within the next 2 weeks. All right. We do have door prizes today. In person, your odds are high, which is great. So we do have one here. So someone's leaving today with a Yeti hopper cooler. Virtual attendees, somebody will win. So we'll announce that at the 1:50 p.m. break. A good reason to stick around. All right. Any other assistance you need? Again, you can reach Julia Ray, jray@deandorton.com. She's in the back of the room if anybody in here has technical issues too. Great. All right. So that's kind of the start this morning. First up is Kaydee Ruppert. Again, Kaydee is from our Dean Dorton team out of Wisconsin. She does remote, but she leads our nonprofit group. And so she's going to talk us through endowment management. Hope you guys have a great day.
Make sure we don't have feedback. Do I need to shut this off? Bear with me a second. All right, how's that? Getting the thumbs up, that's great. Okay, I'm Kaydee Ruppert, and as Megan said, I actually live in Wisconsin, so I work remotely for Dean Dorton, but work with a team of nonprofit professionals, and we overlap quite a bit with higher education. So it's a great balance, and we try to contribute to each other's industries whenever possible. So today we're just going to talk a little bit about endowment management. I know that's an area that a lot of colleges, especially 501c3 colleges, have questions about and sometimes get into a little bit of trouble. So today we're going to do a pretty high overview, but hopefully it'll give you an idea of some of those places that you might want to dig into a little bit deeper as we go. So now I have to come over here to click. Does the clicker work? Objectives. So just really briefly, we're gonna go through legal support, make sure that you understand the different types of endowments and the elements of restriction. We're gonna talk a little bit about clarity and accounting, which makes your audit work much easier, and also your succession work a lot easier. The places that I see a lot of trouble happens when there's a turnover in the CFO or the controller, and somebody really knew what was going on, but didn't really codify that in a way that makes sense to the next individual. And then fourthly, we're going to talk about budget cycles and how you might maximize some of your endowment resources to make sure you're advancing the college mission. And lastly, leveraging for organizational growth. So that's a lot for 50 minutes. It's going to be pretty high level, but let's hit it. It all starts with your documentation. And really, we know that there's a lot of endowments that are set up historically that maybe didn't have appropriate documentation, but you can always start with today and start doing a better job. I always recommend that you work on developing a template. That way you make sure you get all of these elements accounted for. And it avoids some of the turf issues that sometimes occur between a finance department and the advancement team or the development team. So that allows you to really just get it all out there, work on this template together, and then move ahead. But the things that you want to make sure are in that template, first address the who, what, and when. Who would be, who's your donor? A lot of times, that seems obvious, but you really need to make sure that that's documented. What has to do with what is the type of your donation? So this is where a gift acceptance policy becomes, I don't think I have a pointer. A gift acceptance policy becomes really important. And you want to make sure that your gift acceptance policy is actually referenced in your solicitation materials, and that indicates whether or not you're going to accept things like real estate or stocks or a boat or some of those really obscure things, a coin collection, and what you're going to do with it, because then you want to make sure that you have a designated turnaround time on some of those things. A donor that gives you a boat, for example, might expect that to become a resource for the college immediately, but in fact, you may intend to sell it and aren't able to sell it for several months, then there is no money going into your endowment yet at that time. So having a gift acceptance policy to lay out some of those ground rules will just avoid miscommunication with your donors. And then when you want your donor agreement to indicate when the resource is going to change hands. That might be a $1 million gift, $200,000 a year, or it might be all at once. But it's important for your donor agreement to indicate what that timeline really looks like. Then the next bullet there is your intended disposition of the gift. So there's really three options. You can use the gift right away. That would not be an endowment. So picture a template. It's great to have check boxes for these things. So you either choose use it right away, you choose hold it in perpetuity. That's an endowment. That's what we'll be talking about mainly today. Or a hybrid where maybe you're holding a part of it in perpetuity for a while until an event occurs and then it's released for general use. So you want to make sure that all of those options are available, but you have bumpers on those options so that you as the college are controlling how donors are really contributing to you. So you don't get all kinds of crazy combinations that you really become counterproductive to your mission. If you hold something in perpetuity, then you want to make sure that your donor agreement addresses both the intended disposition of the earnings. So a lot of times you'll see where the earnings are intended to roll back into the endowment for a certain amount of time until it hits a level. Sometimes the earnings can be used immediately upon being earned for an unrestricted purpose or another purpose. And sometimes it's a hybrid of that. There might be a college event that happens every 5 years. There's a big trip to Guatemala, and these earnings are intended to be used for that trip. So you've got a time element and you have a purpose element. It's a good spot too to reference your endowment investment policy in the donor agreement at this point. Now with the investment policy and with the gift acceptance policy, and there's one more policy that we'll touch base on, I really encourage you in your template to reference the policy and indicate as modified periodically by the board so that it's not locked at a point in time. And that's important because things change. Public opinion changes, what's considered politically correct changes, investment strategy changes, and those are things that you want your board to be able to pivot on without having to manage 5 or 6 different ways to do that because you locked yourself into a donor agreement 15 years ago. So we want to make sure that that happens. Continuing with the donor agreement then, of course, the purpose is extremely important. So we talk about then whether or not how this resource is intended to be used. And when you're talking about an endowment, you're typically talking about just the earnings. And again, you know, we might have that trip to Guatemala. We might have something that's as generic as the science department for general use. A lot of times you're going to have endowments for scholarships. So you want to make sure that that purpose is really addressed. And my note on here about managing for longevity, that scholarship, try to make sure that your donor agreement thinks about the long-term future. So a scholarship to the COBOL Development Fund probably isn't quite as effective now as it would have been a few years ago. Several years ago when COBOL was the type of programming that everybody did. So you want your documentation to really give you that flexibility for the future. And a lot of times the way you do that is just by saying a scholarship as designated by a specific committee. That way your committee can control some of the details of who qualifies for that scholarship. And you're not locked into this donor agreement that then has to be revised or somehow otherwise addressed after the donors have passed or went another way. You also want to avoid at all costs that perception of individual benefit. So this is where, again, I see it a lot with scholarships, where you have a scholarship criteria that is so specific that it very clearly just benefits the nephew of the donor or someone that they're close enough to where it really gives a perception of unfairness. And whether it's reality or not, that perception can really reflect poorly on the college and your accounting practices. So you want to make sure that the donor agreement, this is the time to do it. It's a great neutral conversation with the donor. You know, we need to do this donor agreement. Here's the template. Here are your options, rather than having them really guide that conversation in a way that might be negative for the college or the university. This next bullet is the thing I see dropped off the most, and it's really, and we'll see an example of this, it's really essential to address recognition in your donor agreement because it's part of the deal. What type of recognition are you planning to give that donor? And how long is that recognition going to last? So if it's naming rights to something, is that name going to be on that building forever? Or is it going to be on that building for the next 25 years or 50 years? So you really want to make sure that those things are spelled out. And again, if you have a template, especially when you're maybe going into a capital campaign, you can maybe have a page on the side where here are your options and give them plenty of options so the donor feels very welcome. But at the same time, you've already vetted those against what's really manageable within your organization to handle and what makes sense for the future. And then here's that last policy. You should have a public relations policy that talks about, you know, when you will disclose names, what those conditions are, how you opt out, so that then the donor agrees to the terms of that public relations policy when they sign their donor agreement. And again, this would be a policy that you'd want to make sure you indicate could be changed in the future by the board. Those policies should all be available, I would encourage, on your website somewhere where they can be accessible to the public so that a donor in the future can always check to see what that policy currently states, or an attorney that's thinking about this donor agreement being out of line. And then make sure you get a signature, because a lot of times we have great agreements and 20 years from now, we can't tell if the donor ever saw it. That signature is the only way to know that they really did agree to those terms and that your college or university agreed to those terms. Oops. Yeah, so we've got a poll. In 1913, Tennessee Division of the United Daughters of the Confederacy donated $50,000 to Peabody College. They did have a gift agreement. It was signed, and it specified that the Associated Women's Dormitory would be named the Confederate Memorial Hall. So that went to court. This isn't the whole question here. Do we have the whole question somewhere? Yeah, there are much more important characteristics there. So what happened was that Peabody College was absorbed by a university. Which university was that, Julia? Do you have that handy? Vanderbilt, I think.
In 1979, Peabody College merged into Vanderbilt University. In 2002, Vanderbilt changed the name of the dormitory to Memorial Hall, based largely on student protest of the dormitory's former name. The Tennessee Division of the United Daughters of the Confederacy sued. What was the outcome?
So we'll give people a couple of minutes to answer that question. People online, don't look it up. That's cheating. Okay, I like it. I don't like it, but I kind of like it when I stump an audience because that means we have something to learn. C is actually the correct answer. The court required Vanderbilt University to reverse the name change because they had a written donor agreement that said that building would be named Confederate Memorial Hall, and it did not indicate an end date. So they required the university to change that name. I'm not sure what happened after that, if they came to agreements with the Daughters of the Confederacy, but that was the court ruling, and it was a little controversial. It was first ruled the opposite. It went to appellate court, and the appellate court ruled in this direction. So it's important to have those details about publicity and recognition detailed in your donor agreement in a way that your college or university can live with forever. So those things go to court. I mean, this happened in 1913 and it was 1979 when it went to court. So stuff to pay attention to. So we're going to focus on endowments now. And these are, I encourage a donor agreement for all donations. But if they've marked the checkbox that any portion of this gift should be held in perpetuity, that becomes then an endowment. And endowments are 3 types. We've got the type that's a true endowment, and that's where this donor asks that a portion or all of their gift be held in perpetuity. That's a true endowment. Then you have a term endowment where the donor again has requested that it be held in perpetuity, but there's a condition, a time period, or an event that will cause it to no longer need to be held in perpetuity. So this might be, establishing an endowment for a new building for the next 25 years to maintain it so that the earnings can be spent on maintenance. And after such time, it's released from endowment and can be used by the university or college as the college sees fit. So that's an example of a term endowment. The last type is a quasi-endowment, which really isn't an endowment, but it's generally invested with your endowments. A quasi-endowment is when your board takes action to move a portion of your unrestricted funds. So gifts that have come in the past, tuition that's come in, things that were not restricted to any particular purpose and that were not endowed in the past. And the board is saying, we really want this principle to be held so that we have earnings to use for a specific purpose. Sometimes it's used as a jump start on a new endowment too. We really want people to give to scholarship program, general scholarship program. So we are going to start a fund and put some of our university or college dollars into that. And those funds are not donor restricted. So they, on your statement of financial position, will be included in without donor restriction, but in your investments, they'll be in long-term investments endowment. So we'll talk more about those as we go. That's sort of your statement of financial position, where it ends up on your net assets, whether it's with donor restriction or without donor restriction. On the flip side, on the statement of activities, we want to know when are we going to recognize this revenue? And, over the last decade, there's been quite a bit on revenue recognition. And there's really 2 parts there. There's when is it going to be recognized, and then how is it going to be recognized? So the first is the timing, and that's the when. And typically for any type of a gift, when you receive the pledge, you recognize it as revenue when there is that general commitment that you know that these resources are going to be coming. You recognize it when you receive that commitment, as long as there isn't an obstacle or a barrier to being able to recognize it. Now, holding something in perpetuity is considered one of those barriers. So if you receive a pledge for an endowment and you don't have the cash yet, you don't recognize it as revenue yet because you have not honored that barrier yet. So you've got that commitment. That's a great off the books thing. You want to make sure the donor is recognized. There has to be coordination with your advancement or development department. But it's when you get the cash then that you recognize revenue, and the offset then is cash, which would then pretty quickly go into your investment account for the endowment itself. You can't put in your investment account money that you haven't received yet. So an endowment typically requires a receipt. There's a couple little exceptions, but they're more rare. Then the second is the how. How are you going to recognize that revenue? Is it going to be restricted or unrestricted? So you've got two parts there. You have your principal, the corpus of your gift, and you have any earnings that are incurred over the life of that gift. The principal itself, if we're talking about a true or term endowment, we'll recognize that as restricted because the restriction itself is maintaining it for perpetuity. That in and of itself is a restriction. So even if the earnings can be used just for general operations of your organization, you can't touch that principal. So the principal itself becomes a restricted revenue that then remains on your statement of financial position as a net asset with donor restriction. Now the quasi-type endowment, remember that revenue, when we talk about time, was recognized whenever that came in. That could have been a sale of a sweatshirt in your bookstore and the money's left over. Could be from forever ago. That money you've recognized the revenue long ago, and now you're just moving that from your general checking or your money market, you're moving it into an investment account. So there's nothing happening on your statement of activities when it comes to a quasi endowment. Then when we talk about the net earnings, this has to do with then the purpose and the time of that purpose. So if you have an endowment that's for general operations, as those earnings are generated, you would recognize revenue, whether it be realized, unrealized, the fees that are associated, all those things that go into your net earnings for that fund are recognized as unrestricted because they're for general operations of your organization. So there's no restriction on those earnings. They can be used right away. They can be used in whatever way you want to use them at your college. If you have a fund that's maybe restricted to the science fund, so the earnings are designated in your donor agreement as being something that is for the science department. I want to make sure I get my terminology right. The first dollar rule gives us the flexibility, or really the mandate, that if there are both restricted and unrestricted funds that are used towards that purpose, so the general management of your science department, you would use your restricted funds first. So you have the option to recognize those earnings on your statement of activities as really unrestricted right away. They're going to be used right away in your science department. It's part of your general operations. You are required to put it in your science department, but you don't have to go through the process of recognizing them as restricted, releasing them, and then using them in your science department, as long as the donor agreement supports that. Now, if it's something very specific, now let me step back. You can recognize them as restricted, go through the process of unrestricting them, but you should do that during the year in which they're earned, because they are unrestricted technically under the first dollar rule in that time period in which they're earned. So the other thing though is time. If you have a very specific, purpose, if you have a very specific purpose, a particular piece of science equipment that you have solicited for, and it's only replaced every 10 years, something very technical. Those funds then need to be held as restricted. You would recognize the earnings as revenue that is restricted for that particular purpose. And you're not able to unrestrict them then until you reach the point where you're going to actually incur that eligible expense. The same applies to time. If this is a grant where the earnings are meant to be used for the subsequent year, that's spelled out in the donor agreement, then you have a restricted gift based on time. It would be restricted, and then it would be released the subsequent year to be able to be used in general operations or whatever the purpose is that's indicated on the donor agreement. So it all comes back down to that donor agreement. It's very important that you have that chart coming from your donor agreement on this is how the principal is going to be accounted for, and this is how the net earnings are going to be accounted for. I'm going to jump over to fund identification first right away, because it kind of plays off of what we were just talking about. Those things I just talked about then, about how we recognize revenue, you want to make sure that your accounting infrastructure is set up to be able to handle that. So, I'm sorry, Julia, I can't see what you are holding up. Oh, thank you. I'm getting old. You want to make sure that your accounting infrastructure is set up to be able to deal with that. So most of our accounting systems now have an ability to have dimensions or segments or some sort of a tag, for lack of a better word, that allows you to indicate what its restriction is, if it's restricted, what its department is, those types of things. So as you get a new donor agreement, that's the point at which you want to think about, how are we going to manage this fund? And you may already have an endowment fund, the asset side of it, that rolls into your investment account and that rolls into your net asset account. But you may actually need to set up a new set of revenue and expense accounts to go with that restricted purpose if it's something new. So maybe you're holding the funds in perpetuity for the benefit to be used for this special piece of science equipment. You might need to set up something specific to be able to track those earnings then as they're incurred. So the best time to do that is at that point of donor identification with the donor agreement. And then there's the distributions themselves. So all of your accounting really happens on the value of that asset. So you have your donation come in, it's endowed, it grows, it shrinks, unfortunately, sometimes. And that's your accounting, that's your revenues and expenses. Distributions are really just moving it from your net investment account to your cash or wherever it is you move it to. A lot of times we get tripped up by thinking about the distributions being what's available or what increases what's available, when in reality that paper value is what's available. So although it may not tangibly be available to you based on your distribution policies, for your accounting records, that's what the value of that fund is. So it's important to distinguish those two things and think about them as you do budgeting. And we'll talk a little bit more about that in a minute. Going back over to investment policy, there's a couple of things you want to make sure are noted in that investment policy, which remember is referenced in your donor agreement. So you want to make sure most organizations pool their endowments. It's just a better investment strategy. So you want to make sure that your investment policy actually indicates that you're pooling all of your endowments, what the criteria is to be part of that pool, or maybe you have a couple of pools. You want to make sure the criteria is indicated. And then you want to make sure you know what your unitization policy is and that you've got that well documented. And that's the changing value of the dollar. So if those, the organization of the Confederate Ladies gave a gift in 1913 of $100,000, the value of that is different now than it was then. Someone giving $100,000 now would not have the same stake in that endowment pool because of the length of time that has passed. So your unitization policy takes that into account. And as you add new assets to your endowment pool, you know what the book value of them are, and then you can assign them units based on the market value of a unit at that point in time. And you want to make sure that your investment policy addresses when that will happen. So if you receive a new gift, you want to make a commitment as an organization to getting it into the fund within a set amount of time, so that you're not sometimes receiving a gift and it goes into the investment pool 90 days later, and then you might get a bigger gift and you're, oh, I got to get this to the bank today. You want to have a set strategy for making sure that all of your gifts are treated with consistency, and that you're measuring what that market value of the pool is, that unit value at the same point in time. So all of your gifts that were brought in, I would suggest in May, all of the gifts are given a unit assignment based on the unit value on April 30th, because that's the last known unit value. You can calculate it on a daily basis, but as long as you're consistent, that's really what you'd be looking for to fairly distribute the earnings and fees associated with your investment pool. And that's what you do with that investment policy. You also want to make sure the investment policy then addresses spending and distribution. So if you're distributing 4% of that, so a lot of times you'll see the last 12 quarters, 4%, 5% of the average balance for the last 12 quarters, something like that. You want to make sure that that's addressed in your spending policy so that you know how much cash is coming back into the college or university to be distributed for the various purposes addressed by the individual funds themselves. Okay. So the fun part comes into budget and spending. And what I see a lot is that you've got these endowments earning money, and people feel like it's not touchable. And it's sitting there, and it becomes what people consider their slush fund or their special wish list fund. You have to go back to that donor agreement. Was it the donor's intention that an individual department head decide how these resources are used, or were they meant to be used for the science department? If they're meant to be used for the science department on an annual basis, then those are really unrestricted funds at the time they're earned. And they should be part of the science department's budget for general operating. If they're meant to be used for a specific purpose, to buy a piece of equipment, when are we going to buy that piece of equipment? There needs to be that dialogue and planning as part of your budget process, so that you're looking ahead at when are we going to be able to release from restriction these funds and put them into use. Donors give because they want your organizations to succeed, and they want to advance the mission of the college, of an individual department, of a group within the college or university. They don't want the funds to go unused. So it really is it's almost a requirement of the college to really honor those wishes and get this money into operations so that you're not increasing tuition unnecessarily or other fees. When you have a situation like I just talked about with the science department, you can drop down here to the first dollar rule. Those are really coming in as unrestricted annually. There really doesn't have to be a discussion. This is part of the funding that's coming into the department. And your department heads, you should be working with them to determine how are they going to allocate their budget each year. But if it's something like a scholarship, you really want to understand who has responsibility for making the recommendation. And we want to be clear in our donor agreements that donors don't select recipients, because that can get you into trouble with that personal inurement situation. What you want is to create some sort of a committee that includes the donors so they can be part of the discussion if that's their wishes. But that ultimately this committee is making a recommendation. And it might be a department head or the president of your college that would make the final decision on who recipients are. Or maybe it's a committee of a much smaller committee of instructors, whoever is most appropriate to make those final choices, but it should be an employee of the college or university itself. Because you ultimately have responsibility to answer to the public for that choice. And you do want to make sure that you're not setting up any sort of a scholarship that creates a discriminatory situation or something that goes against your general principles and policies and values. So planning for those things is really important, and then making sure that that gets communicated with accounting. So not all scholarships, sticking with the scholarship example, they don't always necessarily all happen every year or at the same time every year. You want to make sure there's a feedback loop there when the decision is made, that the finance or accounting team is notified so that the funds can be unrestricted, released, and then moved back into the general pool. And remember, those are paper transactions. The cash itself is distributed based on your spending and on your policy within your investment statement. Ooh. Okay, one more poll. The requirement that no additional funds be distributed to program activity from an endowment that is underwater. Let me define underwater. If you have a book value, someone donated $100,000 to you in 1913, and today its market value based on your unitization is $98,000. It's underwater. Its value is less than the total book value. Which one of these general recommendations, general uniform guidance addresses that? Or indicated that no additional funds be distributed? Okay, looks like almost 100% there. And the answer is A. So that was actually part of UMIFA, that no additional funds could be distributed. UPMIFA now recognizes that due to the change in the markets, there's a common understanding now that it is better to stick with your consistent distribution of funds policy. So if that's 5% of the last 12 quarters average balance, whatever that may be, there's a consistent belief that that will result in a better outcome long-term than freezing the funds and no longer achieving the purpose that the donor intended while you wait for those funds to regrow, which may take more or less time depending on what's going on with the market, which the donor can't control, you can't control. The idea behind UPMIFA is that donations are given to really promote and advance the college and the university. If those funds are not available, it can really hamstring a college or university from being able to remain viable. And if you don't remain viable, then there's no point in having that endowment in the first place. So UPMIFA recognizes that sometimes a critical element in being able to weather the storm of a bad market is continuing to have the resources that you are counting on. And the reason you establish an endowment is for consistent funding. So that was recognized through UPMIFA, which superseded UMIFA and has been since adopted by, I think all the states now except Pennsylvania have adopted UPMIFA. Each state has its own little spin on it though. So there is general guidance and then there is state accepted policy. So I want to talk a little bit about how you can leverage your endowment. And we'll just briefly go over this. We're running low on time, but endowment is really a wonderful thing to have within your college or university. And you really want to make sure that you're leveraging that to the greatest extent possible. And you want to do it with accuracy and transparency. So it's, again, important for your finance teams and your advancement or development teams to work together and to really understand what's going on with the endowment. How successful has it been? What have we accomplished this year? What are we planning to accomplish in the next 5 years? And how can we encourage more people to donate to the endowment? And part of that is really tracking and publishing those accomplishments. You can use that information to really encourage bequests. You can keep those donors informed, even if those donors have passed, keep their heirs informed. That's a great way to keep people engaged in your organization. A lot of organizations have considered policies when they do a capital campaign on having an endowment rider. So if you're going to donate $1 million to the new gymnasium, we are strongly suggesting that you consider 100,000, 10% matching gift to our endowment. That will help us continue to be viable as an organization and maintain this great this great investment that you have made. And a lot of times that's a point where the donor is highly engaged and they understand that they want you to be a viable organization forever. And so latch on to that, take advantage of that. And if you have good statistics to share at that time about the things that you've been able to do with your endowment in the past, how you've been able to keep tuition low and wages high, largely because of your endowment outcomes, those are things that will just do that much more to encourage donors to give. And sharing that information with everybody on your campuses is important, because endowment is really everyone's responsibility. And so many people touch students and parents and their employers. Those are the sources of endowment dollars. And so empowering those individuals on the front line with just little really great tidbits of information will give them the tools they need to be able to do a lot in moving your needle on endowment. And so just the last couple of other notes. We've been talking about, we started by talking about setting up your donor agreement and having that template really reflect all the elements that are ideal. Probably a lot of you have those 1925 gifts that you have a green bar ledger somewhere that says it's restricted to the science program and you have nothing else. You don't know who that donor is. Take some time to try to figure out, when you can, where that donation came from. And if you don't already have documentation that hits on those points we discussed, and that donor is still living, it's a great opportunity to have another touch point. We're cleaning up our records. We'd really like to get a signed donor agreement. By the way, would you like to contribute a little bit more? Here's what we've been able to do. So it's a great opportunity for a touch point. If people have passed, I would encourage you to go to their heirs if you know their heirs, and try to get a donor agreement that's retroactive to recognize that the family agrees that this was the intent. That gives you that documentation you need to avoid the challenges we talked about in our first poll. If you find, though, that you have nothing, or you have something that you really can't manage anymore, it's for the COBOL training program and you don't offer that program anymore, and these funds are just accumulating, then it's time to think about whether or not you want to readdress that endowment and reclassify it as unrestricted. And that's where you need to look at what UPMITFA says in your state and sometimes that's as easy as just filing a document saying we can't find anybody that has anything to do with this donation anymore. And we don't believe that we're able to practically honor the wishes of the donors, and we would like to reclassify it. And typically that's just a clerical issue. It depends to some extent on the amount of the dollars. There are a lot of states that have about a $25,000 threshold that if it's under 25,000, you don't even need to file with the Attorney General. That's something internally you can document and reclassify. So it's just really getting familiar with what are the rules in your state and what type of documentation that you have and what type of constituency around that gift exists. Because even if the original donor can't be contacted, if there is a group of people on your campus or in your community that really supports that, you want to be ahead of that in the discussion. Then you want to do, and that can't all be done at once. So I just suggest that we look for a timeline on that. You know, this has existed for a lot of years. Bite it off in little chunks and try to make improvements every year. And then you want to do budget planning for that spend down money. Like I said before, a lot of organizations are sitting on, you know, you've got your COBOL fund that's just been accumulating, and there's a lot of resources there that you are not accessing, and you're having trouble with your budget. These are resources that are available. So start those conversations, do the planning to spend down those monies that can be spent down, maybe not all in your next budget, but over a finite period of time. And then proactively manage that board designation. Remember that board designation isn't endowed. It isn't truly endowed. It's not restricted. So if its purpose is no longer appropriate, the board needs to probably be reminded, because you have new board members now, that they're the ones that made that designation. And if there is a more appropriate purpose for those funds now, if the college or university is in a really pivotal point in your history, those funds are technically available. So you want to keep that in front of the board. Questions? It's exhausting, isn't it? I have a big decision tree that I go through on endowments, on how you classify them and whether they're actually endowed or restricted, and it gets to be pretty large sometimes. Any questions online, Julia? No? Okay. I'll turn it over. Are we having a break now, Megan, or is it? All righty.